Hi, Brock VandenBerg, president of TaliMar Financial. I have to apologize, I haven't posted a video in a week or so, but our team has been super busy closing a record number of loans this month. In fact, we closed 5 loans this week and 14 this month thus far, totaling over $6.3 million. We are on track to close 16 to 17 loans, totaling over $9 million. In fact, we surpassed $54 million in assets under management, which is a record for the company. Our loan servicing department is crushing it as well, with only 1 late payment this month and no loan defaults. I'm very excited about the direction of the company and focused on achieving our goal, which is to fund over $100 million this year. Before I get too far, please remember to like this video and subscribe to our channel. I post a ton of great content that I think you'll find interesting. Now, I want to highlight a subject which seems to be a popular topic in today's economic climate, and that is interest rates. The Fed has not made it a secret. They are planning to continue to raise the Fed rate through 2022. How can they not? The latest inflation figure for March was at 8.5%. A side note, my dad always brings up the fact that this is nothing. In the 70s, it touched 14%. Let's hope it doesn't get there. That being said, we are getting dangerously close to overheating this market. I had the opportunity to meet with the private wealth group at JP Morgan earlier this week, and they were predicting 5+ interest rate hikes over this year, totaling over 3%. This is an aggressive number and goes to show how serious the Fed is about making sure this economy doesn't get out of control. So what does this mean? Well, by raising interest rates, the Fed is making it more expensive to borrow, and this should directly impact real estate. By raising rates, the borrowing cost to purchase real estate increases, which theoretically should result in slowing sales and prices falling. Now, there are plenty of other factors that affect real estate values, primarily consumer sentiment, but we can't put our head in the sand and say home values are going to rise forever. The question is, when will prices stabilize, and what should we be doing now to protect ourselves from downside risk? The first is to remain calm. My team is tracking the trends in the markets that we are lending. They're looking for days on market, increases in inventory, and price declines. None of that is showing in any California market right now. The second is to watch payment default and maturity defaults in our portfolio, and those are at 0. The third is to ensure that we're lending in core markets that are supply constrained. And there really isn't a market that's any more supply constrained than San Diego, which makes up roughly 90% of our loan portfolio. One thing that has caught my eye, though, over the last 3 months is the capital markets. When I refer to capital markets, I mean traders that are buying and selling mortgages. One of our biggest competitors are the Wall Street-backed hard money lenders. They offer aggressive lending programs at very low rates. Where I may quote a mid-8% rate, they're quoting mid-6% rates because the cost of their capital is so low and the demand for hard money loans is so high. However, due to concerns about medium and long-term interest rates, the rates that they are now quoting have jumped a full 1 to 2% and are simply on par with the rates that we're quoting. I think that is one of the reasons why we've seen an increase in loan volume in the company. It is my opinion that rates that they quote should continue to climb, which should give us more pricing flexibility on our rates. Another trend that I'm seeing is the increase in the amount of capital coming into our mortgage fund. We surpassed 15 million in assets under management in the fund earlier this week, which constitutes roughly 30% of our total assets under management. The number one biggest reason why investors are moving to the fund is because they're concerned about the stock market. When the Fed was driving down rates, they were telling investors to increase their risk and invest in risky assets. It worked, unfortunately, too well. Home prices jumped by over 30% in some markets. Now, by increasing rates, they're telling investors to stop buying risky investments and move to more income-producing investments. I believe our mortgage fund offers investors that type of investment. My biggest concern in real estate right now are lenders that are heavy in construction loans. I think inflation has blown up project budgets and borrowers are having to recapitalize their projects with their lenders. If values continue to climb, recapitalizing a construction loan isn't too difficult. But when values start to decline and the amount of equity in a project starts to get squeezed, is when lenders and investors start to get into trouble. It only needs to start with one lender who gets nervous and stops writing construction loans to start that domino effect with other lenders. Looking at our loan portfolio, we don't have a heavy concentration of construction loans beyond the cosmetic fix and flip, which should be relatively sheltered from inflation risk. I want to end this video by saying that I am bullish on the housing market long term. I think markets like San Diego, Orange County, Los Angeles, San Francisco are all markets that suffer historically from a supply imbalance. Yes, short-term stocks may negatively impact these markets, but those shocks will impact secondary markets a lot more. That is why we focus on our lending in core markets. Also, with rate uncertainty, shifting to investments less reliant on appreciation, such as value-add real estate investments, and more reliant on cash flow, such as debt, will definitely decrease the risk of a portfolio. Now, if you liked what you heard, or you didn't, but you still appreciated the video, please give me a like and subscribe to our station. As I had mentioned earlier, we post a ton of great content on the real estate industry and insights into our loan portfolio. If you're interested to learn more about TaliMar Financial or invest in our trust deed offerings or mortgage fund, please do not hesitate to reach out to my investor relations team. You can also go to our website and learn more about our trust deed offerings or the mortgage fund under the investor tab on the site. I also encourage you to create a user account for our lender portal by selecting lender portal on the investor tab. You can view all our trust deed offerings through the lender portal and stats on the mortgage fund. Again, thank you for listening and look forward to hearing your comments.